Good morning, everyone, and a very warm welcome to this, our very first Employer Solutions webinar. So if I may just have a minute of your time, just to give you a bit of background to Employer Solutions and what it's about. So really it came out of discussions internally. We're thinking that for us, for Bishop Fleming, people are our greatest asset. And looking after those people, our workforce, that's quite a responsibility. It's an honour, and at times it's quite a challenge. Now, some of those challenges I am very happy to leave to you, but there are some that we as a firm of accountants, of tax advisors, of financial planners, of payrollers, that we're very well placed to help you with. And retention and reward is probably an area of specific focus. And we've sort of gathered together our expertise from across the firm to put together our Employer Solutions team. Now, already we do an awful lot with you on the employer side. So it might be payroll, it might be the furlough claims, and what a joy they've been. It could be P11Ds, it could be advising on benefits on people moving around the world. But actually the Employer Solutions, it's a different focus. It's less about us looking back and reciting a set of rules, which of course as accountants we do like to do because we think it makes us look clever, but it's much more about really understanding what you're trying to achieve and make sure that we've got a solution that is the best outcome for all stakeholders, whether that's you, the firm, whether it's the individual worker, employee, contractor, whether it's the other people that are working around them that are impacted on what we do. So today we're going to be focusing on status. Now, it's been in the news again recently. There was the Uber case that was sort of settled last week after 5 years of battling, just showing how complicated it is. After 5 years of battling, Uber has decided to make all of their drivers workers. It's an employment law case. It's not the same as tax law. Wouldn't it be great if it were the same? But it just goes to show how complex it is and how long these things can last. Now, before I rattle on too much longer, I'll just say, as we go along, please do feel free to ask questions. They'll go in a box and we'll come to those at the end. But if we just let our presenters try and walk us through the complexities, make it all seem jolly clear, I'd like to hand over now to Adele Clapp and Dominic Harry, our experts on status. Thank you very much.
Thank you, Izzy. Employment status. Why the big deal? Well, in an environment where you have to consider whether, for a number of reasons, somebody is employed, a worker, or self-employed, for tax purposes, the significance of employment status is possibly best explained by way of an example. So suppose I engaged to work for Bishop Fleming for 6 months and agreed a fee with them of £50,000 for the work that I do over that period. If I were to be employed by Bishop Fleming would have to pay me £50,000 plus employer's national insurance in the region of about £5,500. BF would also be liable to make employer pension contributions, provide, if appropriate, statutory sick pay, holiday pay, etc. I would be entitled to a whole bundle of employees' rights, and it all racks up. If instead I engaged in a self-employed capacity, the cost to Bishop Fleming is £50,000 only. No statutory sick pay, holiday pay, pension contributions, no employee rights, etc. This led to an almost inevitable outcome that where engagers could, they would prefer to hire workers under self-employed contracts rather than as employees. HMRC were losing out on revenue, and the larger the number of self-employed engagements that existed, the bigger the loss to the exchequer. HMRC therefore started to make more regular challenges on employment status, on the status of consultancy type roles and other self-employed arrangements. The result of these challenges were listings for tribunal hearings, the hearings themselves, court hearings, and ultimately case law. And as a result of these various cases and hearings, there has evolved an important list of key employment status tests.
So we are going to look at these tests from a tax perspective, but it should be remembered that there is a difference in determining status from a legal and a tax point of view. For example, the recent Uber case that Isabel's already mentioned was an employment law case and not a tax case. However, following this court decision, the majority of drivers will now be paid national minimum wage and holiday pay via payroll. So I think it also counts as a win for HMRC. There are more classifications of workers from a legal perspective than there are for tax. For example, for legal purposes, you can have employees, workers, and self-employed workers as the main categories. These have varying degrees of employment rights, and there is a summary showing some of the differences between these on the slides that will be sent out to you. For tax purposes, you can either be employed or self-employed. However, from HMRC's perspective, all individual workers should be treated as employees. So, when looking at the tests to determine status, the starting point is to establish if there is any mutuality of obligations and if the contract is one for personal service. Mutuality of obligations simply means that the individual agrees to carry out some work personally and the engager agrees to pay them for that work. Mutuality of obligations is present in some degree in all contracts, but this is pretty much as far as HMRC go in their definition. They don't consider that a company may be under no obligation to offer or pay for work, or that a worker may have a choice about whether or not they turn up. For professional game match officials, PGMOL case centred around mutuality of obligations. We do have a blog that covers this case on our Knowledge Hub that's been launched today, but as a quick overview, PGMOL provides match officials for competitive games in football. PGMOL have a number of referees who are employed on a full-time basis. However, they also have some referees who provide services in their spare time and frequently work this around other full-time employment. This case centred around these other referees. So the initial argument that was put forward by PGMOL was that these referees were not under any contract with them, and so there could not be an employment contract in place. The three main points from this case were looking at whether there were mutuality of obligations, whether there was a sufficient degree of control, and whether the other provisions of the contract were consistent with the referees being in business on their own account. The first tier tribunal concluded that there was no guarantee or promise of work in the overarching framework, and therefore this couldn't constitute an employment relationship. On the first appeal to the upper tribunal upheld the original judgment that there was insufficient mutuality of obligations in this arrangement for the referees to be employees. HMRC are appealing this case, and it is due to be heard later this year by the Court of Appeal, so this is one to watch out for. Turning to personal service, if a contract allows for a substitute to be used or the individual can use their own workforce to carry out the contract, then the contract is unlikely to be regarded as one for personal service. Therefore, the relationship can't be one of employment. The ability to use a substitute should be a genuine right and should ideally be unfettered. This just means from HMRC's guidance that the client company doesn't actually care who turns up to perform the contract on a day-to-day basis. If this happens in practice, I would recommend that records should be kept just in case of any future HMRC inquiry. Substitution has been considered in a number of tribunal cases, and these cases have shown that it's not enough to have a substitution clause in the contract if it is likely that a substitute would not be accepted or the individual won't pay them directly. Moving on, the next step is to look at the level of control in the relationship. Here we're looking at whether the client company can exercise control over the individual, even if they can't control what a worker does on a day-by-day basis. And this was one of the key points from the Uber case. Control is broken down into what they do, how they do it, when they do it, and where they do it. HMRC place more emphasis on the what and whether you can redeploy the worker to another role as being indicative of employment. However, where there is no control or right of control over the what, it is the when and where that become more significant. For example, consider the difference between a chauffeur and a taxi driver. A chauffeur is under the control of the person they're driving. They tell the chauffeur when to be somewhere and where they need to be, whereas a taxi driver has a lot more flexibility in how they run their business. The final step is to consider if the individual can be considered to be in business on their own account. There are a number of different factors to consider here, but broadly, we are looking at whether they can work for anyone else and are actually actively looking for other work, if they can make a loss from the contract, for example, if they have to incur significant expenditure that they wouldn't be able to recover if a contract fell through, for example, in providing their own equipment or bringing in goods or parts to service a contract. And we're also looking at whether they could actually make a profit from the arrangement. Other factors to bear in mind would include whether they are integrated into your workforce. So, do you have someone who signs in using the same procedures as an employee, wears company branded uniforms, have work email addresses, or are invited to staff dues? If you do, then this is a strong pointer towards employment. This is obviously a very broad overview of the tests that could be considered, as we don't have enough time to look at them all in detail. HMRC, rather helpfully, have set up a check employment status tool indicator, the CESS tool, that can help you to determine status. However, in order for HMRC to accept a CESS ruling, whoever completes the tool will need to take reasonable care. So HMRC define this as acting in a way that would be expected of a prudent and reasonable person in the client's position. They should also complete it in line with HMRC's employment status manual. I'll come back to that in a second. The CESS tool does consider the majority of the tests that I've just mentioned. However, it does use HMRC's own definitions for them, regardless of conflicting case law. It should also be noted that the CESS tool is only accurate in about 80% of cases. So 1 in 5 of the rulings that you get on average will be inconclusive. So what do you do about those? Our experience of the CESS tool to date is that you do need to have HMRC guidance open when you complete it, as some of the questions aren't as straightforward as they look. For example, they have a question on funding vehicle costs, but when you actually answer this question, you need to ignore commuting costs and private use of a vehicle. Therefore, you really do need to understand what HMRC are trying to establish when you answer the questions. In practice, we see CESS tool results from both the engager and the worker perspective. Frequently, they will have different results based on their own interpretations of the questions. When this happens with our clients, we act as an independent reviewer and help with communication between the two to try and reach an overriding conclusion. I'll talk about my experiences with HMRC later.
So there are some very important points to take from Adele's observations. The first one being the matter of control in the professional game match officials case. You see, I had inside information that HMRC could have benefited from. HMRC were not aware that there was clearly an element of control exercised somewhere, because Plymouth Argyle always seemed to get the rubbish referees week in, week out. Anyhow, back on topic. It was, and indeed still is, really important to take care when considering employment status tests and making use of, for example, the CESS tool facility. If you are the hirer, the end user client, or an agency, and the intermediary or the contractor you are engaging with completes the CESS test and gets, shall we say, the preferred answer, i.e. they're not within off payroll or not within IR35, or they're self-employed, as Adele said, have they answered the question properly? Have they addressed all of them the right way? Have they interpreted what, for example, HMRC's view of financial risk means? Have they considered the revenue's guidance in its manuals? You know, on that test, it's difficult really to see and build a case that a contractor that's selling simply specialist knowledge or expertise can demonstrate financial risk using the revenue's guidance. What upfront costs and specific contract costs do they incur? I've seen a number of situations all the same where that box has been ticked to say that they do incur financial risks. Although the CESS toolkit is, shall we say, far from critically acclaimed, as Adele has alluded to, HMRC's guidance in their employment status manual, I think, is at least reasonably clear. And that is not to say that we necessarily agree the outcomes that HMRC reach on what to look for when applying the various tests, but at least we know what they will be looking for when considering the CESS results. So arm yourself with CESS results. We'll share the link to this where you can find the questions in our notes, and we'll of course be happy to help with working through the questions with you, and indeed the tests if you like. Arm yourselves with appropriate advice. That's tax and employment law. Build your case. Keep evidence that you have given the matter careful and sensible consideration in reaching any decision that you have made. And be prepared for the possibility of an HMRC inquiry. And that's not me being pessimistic. more a reflection that given the routes available to HMRC, there is a high risk that they will raise such an inquiry. So they've got possible ways of getting into this. The first might be that they will carry out a routine pay-as-you-earn visit or pay-as-you-earn check. Agencies already have quarterly reporting requirements that gives HMRC plenty of information to work with. There have been targeted HMRC campaigns. HMRC have a large business customer compliance team, and it might be one of their managers reviewing a large business's tax position that gives them a way to explore who's been paid and how. And of course, there's HMRC Connect, which gathers and analyses a whole load of data and identifies what HMRC inspectors consider hidden working relationships, amongst other things. Or it might be a simple inquiry into a company's corporation tax return. What's in consultancy, what's in direct costs, etc. All of these could lead to having to deal with a full-on HMRC inquiry.
I've helped with a number of status inquiries that came about as a wider review of a company's affairs, more commonly pay-as-you-earn visits and inquiries. So some of these cases have been quite straightforward and HMRC have accepted responses after one letter. However, I would just point out these ones are quite rare. I've also been involved with cases which have gone on for a number of years, and we have one case in particular that's now approaching 6 years. So this is obviously costly to the taxpayer when you consider professional fees incurred in negotiating with HMRC, and this is before we even consider potential penalties and interest. My personal experience of dealing with HMRC in these inquiries is that if they think an individual's status is debatable, they're going to put forward case law that supports their argument. We'll then obviously put forward case law that supports our own client's position, and HMRC's default response will be to state that every single case is different to those cases that have been heard by the tribunals already. However, this doesn't stop there being quite a bit of correspondence with HMRC arguing the case law, but fundamentally the only recourse to settle any dispute is to go to the tribunals or to settle. One HMRC inspector in particular has told me that they won't actually settle in these cases unless the taxpayer agrees to settle. So unless the case is very clear cut and you do want to argue the case, it will be a case of it going to the tribunals. As part of our responses to HMRC inquiries, we have sent in completed settle rulings. I've yet to have a case where HMRC have actually accepted the findings from these. However, they can help when you come to penalty discussions. We've also had a client who tried the alternative dispute resolution route known as ADR. ADR is similar to mediation and the parties are meant to go into this with an open mind. However, HMRC's opening statement in this particular case centred around their hope that the taxpayer at the end of the day would concede that their workers were actually employees. So very open-minded. They maintained this mentality throughout the day and surprisingly also did not seem particularly up to date with published HMRC guidance in this area. As you can imagine, we didn't actually reach a resolution on this day, but we did hopefully clear up a few misunderstandings on both sides. The only route that's left open to our client after going down the ADR route is to either continue with ineffectual communications with HMRC or, as I previously said, go to the tribunal.
So in a case where a self-employed earner working for a client was successfully recategorised as an employee by HMRC, the inspector could seek settlement of tax, national insurance, interest and penalties from the engager. In this case, it would be the employer now. The burden for making the correct status decision belongs to the hirer. We then saw a growth in the engagers only being prepared to contract with contractors via the contractors' personal service company, their PSC. And this would work as follows. The engager would contract with the PSC for the PSC to provide the services of the contractor. The PSC would invoice the engager and the engager would pay the PSC. The PSC would pay corporation tax on its profits, and corporation tax are significantly lower than the highest rates of income tax. The PSC would then pay a modest salary to a worker, and then the PSC would pay dividends, most commonly, to the worker, and where the opportunity permitted, their spouse or civil partner. Here, the overall tax take could actually be even smaller than that of a self-employed earner working under an identical contract with the engager. It might actually have got worse for HMRC. So this led to the next round of anti-avoidance legislation, which is commonly known as IR35. IR35 requires that you look beyond the contract between the engager and the PSC to see whether the relationship between the engager and the contractor, the worker, is for all intents and purposes that of employer and employee. And that is, just to reiterate, notwithstanding that there is a PSC lodged between the engager and the worker. If the relationship is that of employer and employee, applying the various status tests that Adele has run through, then IR35 applies. And it is the PSC, i.e. the contractor's company, that must decide on a contract by contract basis whether IR35 applies. If it does, the PSC would be liable to account for pay-as-you-earn tax and national insurance on the fees earned, as if broadly they were all paid as a salary to the contractor. Bear in mind here that the pay-as-you-earn tax cost would include an element of employers' national insurance. Now, employers' national insurance is currently charged at a rate of 13.8% on salaries paid above 8,800 or thereabouts a year. So if annual fees within IR35 are around about £100,000, £11,000 of these will be lost to employers' national insurance. And in this situation, the contractor has in effect earned £89,000 rather than the headline £100,000 under the terms of the contract. Because under IR35, it is the PSC's responsibility to determine the IR35 status of the contract. It is the PSC that is liable to pay any tax, national insurance, interest and penalties that become payable if HMRC successfully concludes that it had applied the wrong, i.e. non-IR35 approach to a contract.
So, despite the introduction of the IR35 rules, HMRC quickly came to the conclusion that these didn't go far enough, and they brought in the agency rules in 2014. These rules take precedence over the IR35 provisions and apply where there is a contract between the client and the third party, so the agency, under which the client pays for the services that the worker provides. The agency rules do not apply if, when providing the services, the worker is not subject to or to the right of supervision, direction or control by any person. The agency rules also don't need to be considered if the income that the worker receives is taxable as employment income in its own right, or where the work is actually carried out at a place that is not controlled by the client. The agency rules, finally, also don't apply to entertainers or models. So just coming back to the supervision, direction and control point, there is lengthy guidance on this from HMRC, and some of this does tie back to the control test that we have already discussed. The meaning of supervision, direction and control haven't been tested in the courts yet. However, HMRC's interpretation is that it is about the manner in which a worker actually provides their services. So, similar to HMRC's attitude that all individual workers are employees, HMRC's attitude is that there is an element of supervision, direction and control in all contracts, and it's up to the taxpayer to show otherwise. Under the agency rules, it is the agency that is responsible for withholding tax and national insurance on any amounts paid to the worker. And the final point I just want to make on these rules is that HMRC have previously published guidance that would suggest that the agency rules are most likely to apply when an individual is self-employed. However, this is guidance only. It's also important to bear in mind that these rules do take priority over the off-payroll worker rules.
Let's just briefly recap then. Where an engager hires somebody who is self-employed, the engager determines their status, and it is the engager who is responsible for tax, national insurance, interest and penalties if they make the wrong determination in HMRC's view. Under IR35 legislation, the engager will contract with a PSC, and it is the PSC that is responsible for considering whether the IR35 legislation applies. And it is the PSC that is in the firing line if IR35 is not applied when HMRC successfully determination that it should have been. And where there is an agency between the engager and the contractor, it is the agency that must determine whether the agency rules that Adele has mentioned apply. And if they do, they must account for the pay-as-you-earn tax and national insurance appropriately. So now we move to the off-payroll workers legislation. This legislation already exists for relationships where the end user client is a public sector body. So we have some experience of how it applies in practice already. It will also apply from 6th of April to large and medium-sized businesses as defined, where those businesses are the end user client in a chain working down and ultimately to the worker. Now, large or medium-sized companies are private sector companies that meet 2 or more of the following conditions. The first is that it has annual turnover of more than 10.2 million. The second is that it has a balance sheet total of more than £5.1 million. And the third is that it has more than 50 employees. There are also rules that cover connected and associated companies. And if a parent of a group is medium or large, their subsidiaries will also have to apply the off-payroll working rules, whether or not the subsidiary itself is medium or large. There is a simplified test that applies to some clients and considers only the annual turnover. And you must apply these rules if you have an annual turnover of more than 10.2 million and you are not a company or a limited liability partnership, an unregistered company or an overseas company. These notes, the notes that we will circulate, will provide a little bit more information about this because these tests have to be considered not only in the year that you are making the determinations, but also in determining when a medium or large company becomes medium or large or ceases to be medium or large. So these end user clients must apply the same status tests that Adele has outlined in making their decision. Once they have gathered the information, which could be the CES test or professional advice, they must issue a status determination notice to all the appropriate parties. That could be an agency, the intermediaries above the personal service company, and the personal service company worker themselves. The determination must set out what decision has been reached, as well as why it has been reached. The worker can appeal against this determination. They have got 45 days from the date of issue to do so. When they do, the end user client must reconsider their decision, either stand by it or issue a new determination. Where off-payroll working rules apply, the responsibility for accounting for the pay-as-you-earn belongs to the party in the engagement chain that is immediately above the personal service company, or where the entity immediately above the PSC is not UK tax resident, it is the entity above that, the UK resident entity above that. So if there is no party between the client and the worker's PSC, and the client determines that off-payroll working rules apply, it is the client's responsibility to account for pay-as-you-earn tax and national insurance on the payments it makes. If there is a UK resident agency or another intermediary between the client and the PSC, it will be their responsibility to operate pay-as-you-earn. Generally, these rules don't apply if the large or medium-sized end user client is not resident in the UK, but this is providing that they have no other presence in the UK. And here, having a subsidiary, a branch or an agency in the UK will be sufficient for there to be a presence. Where the client has no presence even, and no tax residence in the UK, the current IR35 rules apply to the working relationship, and this puts the responsibility back to the PSC. And if the end user client is small, i.e. not medium or large, then the IR35 rules that apply now continue to apply to the working relationship. Now, we've not touched on construction industry scheme rules in this presentation. That is actually, it's another subject, and possibly even the subject of another presentation. But for today, it's worth just making the point that the off-payroll legislation takes priority over the construction industry scheme rules.
Okay, so we've now talked about the history, we've talked about the status tests and the various anti-avoidance provisions that are in place. The next consideration is what happens if we get it wrong. So, where pay-as-you-earn and national insurance are not accounted for, the liability for these will pass to the company as the end user. This is because it is easier for HMRC to get the payment from the company than from the worker. And this is going to apply even where the engager has followed every step to try to assess status correctly and they have just reached the wrong conclusion. There are some protections. So if the engager takes reasonable care, then for the tax position, HMRC can only look back 4 years. Reasonable care can include using a professional advisor who has helped the engager come to their conclusion, or use of assess tool provided it's been done carefully and correctly. Where reasonable care hasn't been taken, HMRC can go back 6 years. However, if the engager has got it wrong deliberately, HMRC could go back 20 years. For national insurance purposes, HMRC are limited to 6 years under statute, regardless of a level of care taken. So, where the company does pay the unpaid tax and national insurance for the relevant period on behalf of a worker, this unpaid tax and national insurance actually becomes a taxable benefit in the year of payment. So this can increase the overall tax cost. So going back to Dominic's arrangement with Bishop Fleming, if this gave rise to a £50,000 tax liability and Bishop Fleming made this payment on Dominic's behalf, they would actually end up paying just over £86,200 on behalf of the employee, plus just under £11,900 of employer national insurance. So this pretty much doubles the tax cost before you even take into account the invoiced amounts that Dominic's also received. On top of this, there would be penalties and interest. The penalties will be behavioural based. So if reasonable care has been taken and the engager has worked proactively with HMRC to try and resolve the matter, regardless of the number of arguments raised, the penalties may be minimal. The interest, however, would be charged at HMRC's current rate of 2.6%. For the off-payroll worker provisions, HMRC have said that there will be no penalties in the first year, provided there is no deliberate non-compliance. Therefore, it's very important that you are making a concerted effort to get your processes in place now to show compliance with these rules. I also want to confirm that HMRC have said that there will be no automatic look back or targeted campaigns into earlier years. So if you do change someone's status from April 2021, there will be no automatic triggers for an inquiry. However, our experience of HMRC to date is that if HMRC have become aware of a discrepancy, and bearing in mind they will be wanting to raise funds following COVID, they will raise an inquiry into the historic period. So if you're aware of any historic issues, I would recommend that you look at these and potentially disclose these now. So what else should you be considering now? I would suggest that it's worth reviewing your workforce and being aware of who is actually engaged by a personal service company, who's engaged by an agency, umbrella company, or any other type of structure. I would also suggest that it's worth ensuring that any workers who are essential to your business are considered first, and you ensure that both you and that worker are happy with any changes to a working relationship. When considering your other contractors, it's worth looking at whether they would be classed as self-employed under current arrangements and whether you can actually make any changes to their contracts as they stand to keep them self-employed. If you can't, you need to consider how you're going to bring them in as employees, bearing in mind their own take-home pay will decrease, and also the position of your current employees and whether this may cause any inequality in your workforce. It's worth considering reviewing your contracts, your internal systems and onboarding procedures. The sort of thing that I would suggest you look at is, can all new workers be taken on via a single engagement process, and who will be responsible for this? Who in your organisation is going to make the status determinations? If they're going to be using the assess tool, they will need to be familiar with the employment status manuals for the definitions. For more difficult cases, are you able to call on an expert? And also, who's in your firm is going to handle any status disagreements? The key point is that the proposed provisions mean that you will have ongoing responsibilities whenever a contractor is taken on. So this includes keeping documents or discussions at the start of engagement regarding the status, considering how you pay the contractor, and making sure you revisit the contracts regularly. You also need to keep copies of assessed tool results and consider using assessed whenever a new contractor is taken on or there is a change in the working relationship. It's also worth considering using someone independent to do a ruling, either on an ad hoc basis or for those more complicated cases. Relying on someone's professional qualifications can help with mitigation of penalties, can also restrict the time period looked at in an inquiry. At Bishop Fleming, we can offer holistic advice on this through working with local solicitors to cover both the tax and legal implications of your contracts. One other consideration is to think about your supply chain. Do you know if they are going to be compliant with the new rules? And do you know if the status determination statements are actually being passed down the chain? Finally, you can also obtain insurance that may help with the costs of any inquiry. We offer TaxWise at Bishop Fleming, and some of you on the call may already have this. If you do need any more information on this, please feel free to contact your regular contact at Bishop Fleming.
Thanks so much for that, Adele. That was truly illuminating, guys. Although I'm sure there's plenty of you sitting there thinking, what the hell? How am I supposed to comply with that? And you're not alone. So just to say, this was actually brought up as an area of legislation in a recent paper that went through the House of Commons, through the House of Lords. And the statement made was these rules are not fit for purpose. And we all agree. However, we are where we are and we've got a team here ready to help. I think possibly the best thing to do is if we start with some questions. So I'm just going to work through the questions that we've got published. We've got Sarah's asking the question, we often engage contractors for short-term work via an agency. Now, I think Dom mentioned this in his section. Who's responsible for checking their status?
Okay, I think the answer there is step one is to establish whether the agency rules apply. So I think the agencies would have to have first bite at the cherry. And if the agency rules apply, then the agency will then become responsible for operating pay as you earn if appropriate. If we can get beyond the agency rules applying, then a lot will then depend on whether you are engaging the contractor via their limited company or in a self-employed capacity. So you've kind of got almost like a flowchart. Do the agency rules apply? Yes, it's the agency's responsibility. If not, are they self-employed? Then it's your responsibility. If they are operating through their personal service company, then it will be their responsibility for determining whether IR35 applies. And that is the rules as they are now. Now, Sarah, forgive me for presupposing here, but if you are a medium or large company, the rules will change from April, where you are engaging with without there being an agency between you and a personal service company, and it would then become your responsibility to determine what rules apply and also then ultimately where the pay as you earn, if appropriate, is payable.
Thank you very much. Thanks, Dom. That was quite a tricky one. I think we possibly need a few more of these flowcharts. We've got another question coming from Michael asking, if you engage with a supplier, believe they should be within IR35, but neither of you wish for them to become an employee. From a practical perspective, can you put them on payroll, but clearly indicating in writing this gives them no employment rights, thus creating a division between tax and employment law? Otherwise, collecting PAYE and NI and remitting to HMRC becomes a little trickier. Thank you. Adele, if I may pass that one to you.
Okay, it does depend on whether there's a personal service company again. So a lot of this depends on how you're actually contracting with that person. So if you're contracting with an individual and the tests show that that person would be an employee, then they're entitled to the employment rights and they should be on payroll anyway. And it's your risk as a company for getting that wrong. So any penalties, interest, the unpaid tax, HMRC would go after you for that payment. If there is a personal service company in between, and you're lucky enough that your company is a small company, then the IR35 rules may apply, as Dominic's already mentioned, and therefore the risk of this would fall on the worker. If you are medium or large, then again, they would be classed as a deemed employee in this case. And as a deemed employee, they don't actually have any employment rights at the moment, which is one of the things that they were kicking up a lot of fuss about with these rules, because you'll have people paying the same tax and national insurance as an employee, but not getting any of the benefits. So if they are a deemed employee, you can include them on your payroll. There is a little tick box where you tick that they're a deemed employee, but they wouldn't be entitled to any legal rights.
I suppose just to pick up on that is one area though, Adele, where it might be beneficial, I presume, to be talking to a lawyer at the same time, so we can take care of the tax status, but actually we'd probably be talking with you and your legal advisors or some legal advisors that we work with, just to make sure that that area is covered off in terms of those employment rights, because we don't want to accidentally be giving them where A, they're not wanted, and B, they're not warranted. Dom, got a question for you. How would the IR35 rules apply to casual workers who invoice us directly as self-employed individuals? So we're talking about weekly during a 6-month seasonal period of work.
Well, I think the starting point is here, when we talk about IR35 rules, it's worth sort of just broadening that description a little bit for this answer to talk about employment status rules. So if somebody is engaging with you in a self-employed capacity, you have to look at the tests yourself, because it is your responsibility as the hirer of these self-employed individuals to satisfy yourself that they are self-employed for tax purposes. So the tests about control, supervision, direction, about substitution, all of the tests that Adele ran through in the presentation, you sort of need to work through those, and you could work through the assessed employment status indicator test on a self-employed basis as well, but it is you as the hirer, where you are engaging with self-employed people, who's responsible for making the decision as to whether they're employed or not.
Great, thanks very much, Dom. We've got another question coming through from Phil Chalk. If the engager or hirer is deemed a small company as defined, what form of representation or document should be issued by them instead of a status determination to confirm that they believe the new rules don't apply? Is an email to all relevant parties in the chain stating the reasons sufficient, or perhaps copies of records from Companies House? If I might just pick up on this one, there is no legislative requirement to say that you don't fall within the rules of the status determination. However, you know, in terms of you communicating to people that you work with, that's probably a very good idea. If you have a standard thing saying, OK, this is where we're at, we fall within these parameters, therefore we don't need to issue a status determination. I think that's a very good idea. But there's nothing set out as in what should be or would be required. I hope that answers that one. We've got another question. If the engaging company is small, oh, this is a tricky one, per the rules, but owned by a large US company, does this mean they're classed as small as the parent company isn't resident in the UK? Adele, may I ask you that one?
I knew you were going to do that to me. I believe they would be classed as small, to be honest. I'm not aware of anything that you would look through to have a look at the US company, provided that obviously that what you're doing from a UK perspective is what you're engaging them with. Because obviously if you're a small company, you're engaging with a worker, then you're only considering your position. There are some complicated rules on the group side. I'm not completely up to date with them at the moment, I'm going to be completely honest, but right. I do think you'll be classed as a small company.
Brilliant. Okay. Got a question from Ben. We're a digital marketing agency and a small employer with 30 employees. Don't tick the revenue boxes either. Given the nature of our work, lots of projects rather than retained work, we use a lot of freelancers, contractors who are all off payroll. Does it apply to us?
Yeah, it sounds to me that if you are a small company and a small end user client, you're unlikely then to be within the off payroll legislation itself, and that would mean that most of your working relationships with people providing their freelancers working with you will be within either the IR35 legislation, where they contract through their own limited companies, or the self-employed status legislation, were they to be contracting with you in a self-employed capacity. So it won't strictly be the off-payroll working rules that will apply, but we'll still have to consider the IR35 rules and the self-employment rules as well.
Brilliant. Got a question. What about contractors who don't just work for us, but work for other companies too? That's often a question that comes up. Well, they don't just do work for us. Does that mean they're not employees? Adele, can you give us a bit of a view?
Again, you're looking at each of the engagements on the engagement basis. So you have to look at your relationship with the worker. If they're casual workers and there's no requirement for personal service, then that's one way to get out. If they can supply their own substitutes, again, as I've already mentioned, that's another way you can get out of the rules. But you do have to look at the nature of your contract with that worker.
Okay, thank you. I know we've got lots more questions coming in. I'm frightfully sorry. We are running out of time. And actually, I do think these questions have been useful in terms of bringing it to life. We do have a question here. Do you have to issue a status determination notice to self-employed workers? And I can answer that one. No, we don't have to. It is just where we're actually contracting with a personal service company. So we're fine on that front. Now, there was another question that you won't have in front of you. We had a question at the beginning, and I'm hoping this has all been answered now, where we were questioning the status tests, whether they apply to both self-employed individuals and limited companies. And I hope we've explained where they relate to both, the limited companies being when it's a personal service company, but the same status tests really apply if we're looking at the off-payroll working rules. And we were, excuse me one second. The question was, who has to check their status? And we're talking about limited companies or self-employed individuals. Me, the self-employed, or the limited company. So we're coming back to who the responsibility rests with. And Dom, I think you explained this very well. You actually did it under the agency, but if we can talk about self-employed individuals and also the PSCs, whose responsibility is it? If you can go over that one more time.
Yeah, I may have explained it well once, Izzy, but twice is asking a bit much. So I'll try and get this answer over as briefly as possible, because I am very conscious of the time. Again, if we look at it in a flowchart basis, if you as the hirer are a large or medium company, from April the 6th, it will be your responsibility to determine the employment status. If you are not a large company and you are a large or medium company and you are engaging with somebody through their own personal service company, then we are into IR35 legislation, and that moves the responsibility down to the personal service company. So you would pay them as normal, and it's up to them to review the contract and satisfy themselves or otherwise as to whether IR35 applies. If you're engaging with somebody who is self-employed, then really that is your responsibility to consider the status tests and reach a decision as to whether your relationship with them is really that of somebody being self-employed working with you, or whether they are in fact actually an employee. And then if the latter, then it's up to you to put them onto your payroll and operate pay as you earn.
Brilliant. Just had one final question that I will pick up, just because it's following on very much from this bit. And Michael, I'm hoping that we've answered it there. You just questioned the difference between engaging a self-employed worker versus a PSC. If the worker's self-employed, then IR35 didn't apply. Well, that was your thinking. Whereas if they're supplying via PSC, then IR35 does apply. You're absolutely right. If the worker is self-employed, then you as the contractor, contracting body, you have to sort of determine via their status whether you should be putting them directly onto payroll. If in fact they're engaging with you through a PSC, then IR35 may apply, and that's down to them, or it may be that you have to think about the new rules that are coming in at the beginning of April. I'm hoping we've got it all there then. I'm frightfully sorry, this is really complicated, and I think the guys have done really, really well. If you're still feeling a little bit boggled, we have got a recording of today's presentation. We'll be going live. We will be sending out the slides. And there's a raft of information, articles, blogs, insights and other interesting things going live very shortly on our new Employer Solutions Hub. And I'd ask you to take a look at that because we'll be putting lots of new things on as we sort of evolve. So I just wanted to finish there. Thank you very much again to Dom and Adele for bringing what is a hugely complicated subject to life. I found that really useful and I hope you all did too. All right, look forward to seeing you soon. Thank you.